Hey guys, big changes in the mortgage market today. I'm going to tell you where we were, where we are, where we're probably going, why it all happened, what it means, and what could mess it all up in the future. So we got a lot to cover. I'm going to try and get to all those in just a couple minutes. So first of all, understand we were at about 6.5% for a while. We had a bad jobs report come out a couple weeks ago. That lowered rates to about 6.3%, give or take a little bit. With that, everyone expected that the Federal Reserve was going to lower their rates to by a quarter basis point, and they did that today. So the rates that we saw were already baked in with the idea that they were going to be lowered by the Fed a quarter basis point. That happened. So why did they go down more? So now today they're already down at 6.13%. So almost 0.2 of an additional point. This is really good news, really lower rates, the lowest we've seen in 3 years. Why did that happen? There were some specific things said by the Fed, and I'm going to read it to you. The median participant projects, that means the average Federal Reserve Committee member, that the appropriate level of federal funds rate will be at 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. These individual forecasts are not a committee plan or decision. Policy is not on a preset course. Okay, so they gave themselves a little bit of a hedge, but if you do the math on that, that basically says to get to where they think they're going to be at the end of the year, you'll need 2 more cuts of 25 basis points in addition to today. That's what everyone expected. This kind of says, okay, the Fed's on the path that we expect moving forward. So you're already seeing rates coming down again. This is why we had the drop today, because they're already starting to bake in those future rate cuts. That sort of confirms that the Federal Reserve is seeing what the street is seeing on the bond market. So that's really good news, and that's why it happens. That's why they think we're going to be going down. This is all positive. What this means is you're going to see a lot more buyers come into this market. If you're a buyer who's been waiting, you probably need to jump in now. You may want to consider an ARM. I'm traditionally not a big fan of those because those do implement a bit of risk to your portfolio. But if you think rates are pretty surely going to go down, maybe you get in now while the price of the home is low, and then you get your ARM and a refi later when the rates are even lower if you're confident in that. Now, what can mess this all up? If we get a big inflation report, they're going to be, wait, maybe we only do one more rate cut, and you'll see things flatten out pretty quick. If we get more bad jobs data, that's going to be more on the path of lowering rates. If they get a big good jobs report, I hate to say it, you're actually rooting against that. If you get a strong jobs report, that probably means they might be more likely to hold rates a little bit. So that's where we are, where we're going, why, and what you can do about it.